let anybody else in
Okay.
that comes in a little bit late because they had some stuff tie up on their schedule. But I want to thank everybody for being here today for the January 2022 Prometis Partners Owners Fireside Chat. This is a virtual platform for business owners and advisors to learn about different topics and things that business owners need to be thinking about to not only grow the value of their business, but what are some of the things they need to consider and take a look at when they are actually transitioning out, whether that would be a sale or a transfer to kids, private equity, ESOP, any of those types of transactions, everything but an IPO. So thanks everybody for being here today. For those who have been here before, thank you again, really appreciate it. For those that are new, welcome to the platform and hope that you're able to get some great information out of this. We have a great panelist today and talking about a really, really important topic today. And so we just really want to make sure that we get this information out to everybody. We are recording this, so it will be up on our YouTube channel within a day or so once we do complete it. So you can certainly go over there and like us on YouTube and then watch the video over there. If you have any questions, for those who are pretty familiar with Zoom, down at the bottom of your Zoom link, there is a chat box. Please feel free to go ahead and write down any of the questions that you have. We'll be monitoring those throughout the conversation today, and we'll make sure that your questions do get asked. And so with that, we're going to go ahead and get started. And we'd like to welcome our panelists today, Peter Cavallera. He is the founder, certainly, as you can see, from the Michigan Purchase LLC. Peter is an investor in buying businesses. And what we wanted to talk about today was what does an investor look at when they come in to purchase a business? What are some of the certainly tangible and non-tangible things that they want to make sure are in place, or at least in good order, when they are taking a look at purchasing a business? So you can kind of see Peter's bio there, pretty extensive in what he does and what his background is. He comes to us, although I do think he lives on the west side of the state now, correct, Peter? You are from the east side of the state.
Yeah, exactly. I'm currently outside of the Grand Rapids area. I grew up in Ferndale, Michigan, so born and raised in Metro Detroit. Awesome.
Yep. Well, thanks for being here today. Really appreciate you spending some time with us today and with the group. And hopefully, I know that they'll get a lot out of it. So let's just kind of dive right into it and start asking some questions and having a conversation. So, Peter, you go out and take a look at buying businesses, and certainly I know that you probably have sold a few potentially, but let's start taking a look at it from the buy side. I want to ask one question that I kind of went through and I made some notes on is, when you go to a business that you're interested in, when do you ask the question, why are you selling?
For me, that's almost immediately. It's one of the first things I want to learn. And I think that, and if you put yourself in the shoes of a buyer or prospective investor, it's important to understand that story and understand what the current sellers or the owners or current sellers are looking to do. Part of that is for selfish motivations. Time is of the essence, of course. That's the limited commodity for all of us, and we just want to make sure that we're moving forward with people that are indeed interested in selling their business and aren't just kicking the tires, so to speak. I'm always happy in my perspective to absolutely have conversations with folks and give as much honest feedback as possible about interest in their business, and any questions they have about the sale process and whatnot. But to your point, Vincent, that's pretty much right out of the gate one of the things we want to understand, because it helps us assess if it's truly something that they're interested in doing, and it is a starting point, I think, for understanding what the seller's motivations are.
Yeah, I would also think, though, Peter, that it might throw up either some red flags or yellow flags as you go along, depending on what answer, and how that response is, and what kind of information you get, correct?
Yeah, you're 100% right there. It's one of those things where, in an ideal world, everyone's mostly an open book, and we want to try to be as transparent as possible through the process. But to your point, there's always things that people keep held closely, and absolutely, if you start to learn for reasons that the seller is selling, Yeah, there's definitely some things that jump out, and there'll be indications about the quality of the business or the current circumstances, potential relationships with customers, suppliers, anything that you're saying raises either concerns, alarm, or areas to dig in deeper when approaching it as a potential prospect.
Yeah. Yeah, always got to be careful of that, or at least be thorough when you're having these conversations. So let's talk a little bit about some of the key drivers of the business on the valuations. Can you share with our audience today, Peter, what are some of the key drivers that you look at when you go in to look at a business?
Yeah, absolutely. I think there's the obvious one. We're looking at, from a financial perspective, revenues, profits, consistency, what that growth rate has looked like. I think everyone more or less gets that. There's the obvious thing where you're looking at the profitability of the business and seeing how that's played out over the past few years, how that profit is being generated, is it in a sustainable manner? But that's purely from a dollars and cents standpoint. Looking a little bit deeper and how you're getting to those dollars and cents is another important facet. And for someone in my shoes, especially depending on the size of business that you're looking at, there's that kind of old saying is when you're looking at this business and it's being purchased, is for the next people that are stepping in, especially if the seller is planning on retiring and stepping away from the business, are you buying a job or are you buying a business? So one of the things that's important for people like myself in evaluating a business is how involved are the owners on a day-to-day basis? How involved are they on a tactical standpoint in terms of delivering services and products to their customers? Or do they have enough structure and enough of a middle management team and upper management team built out that they have the luxury of taking more of a holistic view of the business, a strategic approach, and have enough people in place that during the course of a transition, which will always add complexity and a bit of a rocky period to any sale process, that there's enough processes and people in place that should be relatively smooth. And that's something that's very important to me. It's tough to put a dollars and cents value on it, but it absolutely, for two similar businesses, size, industry, and whatnot, that owner involvement and what their role is and how critical they are to day-to-day operations plays a big factor into it.
Yeah, I think that's a great point. And I would suspect this is going to be an obvious comment / question, is you want that percentage to be as low as possible. Because you really can calculate kind of an ROI of how much time and energy you got to put into the thing to really get it to where you want it, right?
Absolutely. And there's that perspective, because you can start to think about, all right, if I need to step into this role or I need to hire someone to step into this role, what is roughly that market replacement rate going to be? How easy is it to actually find someone that can do that work and that has that knowledge and skill set? And what type of disruption might I going to expect by having to replace them in terms of day-to-day delivery of the business's services? So yeah, you can definitely start to calculate that. And I think the part that's more difficult to calculate, but definitely has value, is it cuts down a lot on flexibility and ease of transaction, I would say. So, if that owner really is one of the key drivers of the business's delivery every day of its goods and services, it starts to add an extra element of complexity to the deal, right? Because for all the reasons that we just mentioned about finding someone to replace that, about transitioning that role and having a knowledge transfer and hopefully some type of on-the-job shadowing to make sure that's all delivered. For a buyer, it adds concerns, and it adds just another list of kind of due diligence items and to-dos right out of the gate that are incredibly important.
Yeah, great points. I think it is important for those who are on the call today, especially business owners or those talking to business owners. As I always say, the more inconsequential you are to the business on a day-to-day basis, the better off you are from an attraction. Which kind of takes us to one of our next questions, which we kind of answered a little bit, is what raises or lowers your business curb appeal, right? Certainly this is going to be right up there, but what are some of the other things that would give it either more or less curb appeal?
Yeah, something tied into it, and absolutely number one, yes, certainly the owner's involvement and where they sit in the business and how they fit in, but kind of tied to that, and that usually go hand in hand, is I guess I would describe it almost as how well the business is able to function without leadership involvement, and usually that's reflected by things like process documentation, standardizations that are in place, different tools and technology that are being utilized. But the notion that the less hands-on an owner has to be with the business, the more valuable it's going to be. Because once again, it could be generating the same amount of profit and have the same amount of revenue as another comparable business in a comparable industry. But if that owner is the type of owner who has made themselves so invaluable and indispensable, or generally speaking, if all the employees function in a way that no one is really able to step away or pursue another job or retire without severe disruption because everything is upstairs rather than on paper or documented or being transferred to different tools and technology, once again, it adds a lot of risk and concern to a potential investor.
Absolutely. And from the financial side, it really, if they're not, especially on the technology side, I would have to think that it makes it much more cumbersome to really dig through the financials and then understand how is this business going to be managed with the current system that it has and how much money has to be put in to bring that technology up to speed, right? I mean, at the end of the day, since the turn of the 21st century here in 2000, it's just been kind of a warp speed of technology advancements. And there's really almost no reason to have advanced technology in every business. Wouldn't you agree?
I couldn't agree more. It's one of those things where even businesses that sound intuitively like they're going to be low tech typically benefit from some type of investment. I'm not saying that technology is the answer and it's going to be the core value driver for every business, quite the opposite, but it certainly helps with a lot of facets, especially in a transition in terms of reducing risk and making sure that things are well documented and that the business is adaptable for the future. So, regardless of what industry you're in, if the company is doing things like utilizing potential sales and marketing and advertising technologies in a meaningful manner, or using customer relationship management software, or using enterprise resource planning software, all these different things that, to your point, Vincent, when you're going through due diligence and digging things up, it's not me asking someone to look in an actual drawer and pull out pieces of paper and grab a shoebox full of receipts and all the other things that a business could be doing that's still profitable and runs well, but is going to add to that list of investments and transition costs that are going to happen, because presumably whoever's buying this business, the expectation is that they're probably going to want to start to modernize these things, and there's a cost that goes along with that.
Yeah, that's true. And a number of the things you mentioned, certainly it is correct. Is you don't need to have technology overload, but there certainly are some foundational pieces that businesses should kind of have in place just to kind of keep moving things forward. So just want to take a second here and remind everybody again, if you have any questions, please feel free to put them in the chat box. We want to make sure that your questions get up here and we get them answered if we're not already going through them. So we talked a little bit about profit, certainly looking at some of the financial statements, the consistency of those profit margins obviously are going to probably be a big driver, and the consistency even of the gross revenue. Have you seen an increase in the revenue compared to the industry? Peter, how much time do you spend once you kind of dive in to look at a business in comparing the one that you're interested in to its industry counterparts?
It's a really good question. You're probably going to get a lot of variance from people like myself, depending on what their working process is. And I'm sure also the size of the investment that they're looking at. Like so many things, it is a little bit incumbent on the convenience of data that's out there. Typically, the bigger the businesses are, the more they're going to have available to you in the way of that. But I would say from a comparison to the industry standards, it's pretty brief for me. Once I look at some key statistics like gross margin, operational expenses, bottom line profit margin. Outside of that, I tend to move on pretty quickly from all the different comparators within the industry, only because I'm a little bit of the mindset that a lot of these businesses, especially in the lower market, are going to be somewhat unique in the way they operate. Certainly, there's a baseline that I want to understand. If they are operating at a profit margin that's 75% lower than what, you know, the average rate is within their industry, I'm going to have some concerns. At the very least, I'm going to want to understand why it's operating at that rate, and if that's something that could be remedied, because perhaps it's just one of those things that the owner hasn't made any meaningful investments in a while, or they're yeah, they just are not involved in the day-to-day and are not aware of certain things that could change. But you know, if it's very significantly one way or the other, I might dive in. But as long as it's within a rough range that seems representative of the industry, my viewpoint is I'm going to move on pretty quickly from that, and I want to start to understand things that are really specific to that individual business.
Yeah, absolutely. So when we start taking a look at what are some of the other curb appeals, you know, when you start taking a look at businesses, certainly how much that business owner, how much they've really planned to get them to the point that they are at that particular moment in time before you walk in the door, so to speak, right? So do you spend much time looking at things like how well their strategic plan has been laid out, or a basic business plan when you're taking a look at, so that you understand, or at least have a clear idea that that people have given some thought to how they're going to move this business forward and keep it moving?
Yeah, I do. And it's an indication of, for me, how well that's tied into those other points we're talking about in terms of how involved the owner is in day-to-day, how well they have processes documented, how well they're using tools and technology. But to your point, like so many other things, when a business and an individual are well prepared, it also adds value, and it adds comfort and lowers risk. So when I'm sitting down, and it's very apparent that some owners have put a lot of time and thought into what they want to get out of a transition, how they expect it to go, what they have in mind for a succession plan. That, again, tough to quantify, but is a value driver to me, and one of those things that I want to sit down and understand immediately, because there's certain people, certain business owners I've talked to where you have that conversation with them, and this is clearly the first time it's ever crossed their mind in any meaningful manner. And there's other folks that have had a plan laid out for several years and are updating it constantly and keeping track of what's changing within the business and what, you know, needs to be addressed at the time of sale. And it's a very good indicator of me of how the business is generally run usually.
Right. Yeah. I think you, excuse me, I think you hit the nail on the head. I think it's, you know, certainly when you have somebody who has put together a fairly detailed strategic plan, understanding where they're trying to take this company, what some of their objectives are and their tactics and whatnot, and they kind of drill it down. At least you know they've given a lot of really good thought as to how are they going to get there, and what's the direction of the company to help them move forward. So we're going to take a minute here, Lisa. We have a poll question we're going to be asking. You're on mute, Lisa.
I just sent that to you so that you could see it. It is, how would you value your business?
Yep.
I'll launch that.
Yep. So if people want to take a second just to check a box, how would you value your business, whether it be the revenue/income multiplier, gut instinct, third-party professional opinion, or see what the market offers? Everybody could just take a minute and answer the question. That'd be great. Give it just a couple more, 20, 30 seconds. Everybody just wants to take a second and check which one they feel is best appropriate. Do we have some results, Lisa?
The majority is the third-party professional opinion.
Yep.
And then about 33% is revenue income multiplier.
Okay. Okay. So Peter, when you're looking at valuing a company, do you use a multiplier, a standard multiplier for the most part, as a starting point for a discussion?
Yeah, it's an interesting response there. Yeah, typically, yes. I'm gonna, depending on the industry and the size of the business, I'm at least, my starting point is going to be a range, and that multiplier is typically going to be a result of, for me, it's some type of income metric, and even that might shift a little bit, whether or not it's something like pre-tax cash flow, like EBITDA, or if it's something that is cash flow less capital expenditure, something if it's a very capital intensive business. But yeah, that's going to be my starting point. And to your point, Vincent, I will also, when it's appropriate, look at some third-party databases to kind of gauge that as well, because there is going to be variance within industry depending on the prospects of that industry growth, how mature it is. That range of multipliers, even for similarly sized business, might be different if I'm looking at something in manufacturing versus something that's going to be in healthcare related or something like that.
Yeah, I would think it has, there's going to be a huge difference on what that multiplier is as to, what's going to be happening. And then I got to suspect is that when you start having the conversation about a multiplier, that actually could change in one direction or the other once you start doing the due diligence, right?
Yeah, absolutely. It's just a starting point, and my view and policy is that when I put together an initial offer, I want it to be as robust as possible. Ideally, it's just an ease of transaction for both sides. When that offer goes out, in an ideal world, yeah, that's the price that we settle on, and it hopefully it doesn't really change one way or the other during the course of due diligence. But absolutely, things that you find out and discover during the course of due diligence are gonna affect that. And the hope is that you can knock out some of those big questions initially when you're putting together that offer.
Yeah, so that's always important, certainly for the owners that are listening in today. Certainly the initial offer may not be what the final offer is. It certainly could go up or it could go down just based on what actually is found out once you start to kind of go through the due diligence. When you're starting to talking about purchasing, so you've kind of gone through the conversation with the owner, you've started to really look at the business as a whole. When do you start talking about financing with the seller? Is that pretty early on in the conversation?
Yeah, I like to have that conversation as soon as possible for a couple of reasons. One, it's a reality that it's going to be important to both sides, right? That everyone's on the same page and understands what the expectations are. I don't want to pull the kind of seeming bait and switch thing where I'm throwing out an offer price or something like that, and then, oh, by the way, that's 100% seller note or something. That's, I don't do that as being very productive to the course of discussions. So especially if there's anything out of the ordinary with financing that I have in mind, I want to table that as soon as possible, because it could very well be a deal breaker for one side or the other. And the other part too is, for me, I think a lot of owners and that have very valid concerns that when a buyer comes to them, do they have the money, more or less? Can they put together the financing, or do they have the cash, whatever that combination may be, and that they are going to close the deal? So that's where, when I start to have that discussion, I want to share as quickly and as often as possible. I'm speaking with certain bankers, or I have another lender that I'm working with, or I have X number of investors on board for this amount of cash, and just kind of keep everyone updated and posted on that, because I know that that's going to be a key concern from the seller's perspective.
Yeah, get it out on the table early, just so it's not chipping away at everybody, and we're just
Right.
being upfront and having full disclosure. So you're getting in and you're talking a little bit about, you both are kind of in the realm of what the offer is on the table. Then you have to start taking a look. Certainly there's some due diligence that goes along with this, but let's talk about the clients of a particular business. How granular do you get, Peter, when you're starting to really take a look at the clients, right? So if it's a lot of clients, are you trying to say, well, give me a list of your top 20% most profitable clients? Are you looking at stuff like that just so you can kind of get a general idea of what the makeup is of who their customers are and what they're doing, and maybe even the frequency of their purchases?
Yeah, it's a really good question, and one that actually ties back to a point that we discussed earlier, and that gets into that notion of curb appeal for a business, right?
Mhm.
For me, that's one of the first data items that I want to request and get an understanding of, even if it's an anonymized list where you're not giving the actual names of the customers, it's just customer XYZ 1, 2, 3, whatever. I like to see the complete customer list, from the past fiscal year, past 2, 3 fiscal years, whatever that's going to be. And some of the things I'm looking for, one, if it's the type of business that lends itself to it, how many of them are repeat customers? What is that churn rate year over year? And, are they finding a new list of customers every single year? Or are there people that have been doing business with them for 2 decades or something? And then, the biggest thing for me that I want to understand, and this really plays into that curb appeal standpoint, is do they have any significant customer concentration? So when I get that list and I see a business and they have 35 customers, but the top 2 customers make up 80% of their business, that's a huge point of risk. And it's a big enough point that it's going to either alter the price that I'm willing to offer for the business, or I'm going to add in some fairly strict contingencies to go along with it to hedge against that risk. I ran into a business last year that I was looking at, and it was a fantastic business, highly profitable in industry. I was very bullish on it and would really want to pursue it, but the deal ended up falling apart once we started talking about the offer price. And the main reason was that we couldn't come to terms on a key risk point. And that key risk point was that one customer comprised about 60% of the revenues. Now, from the perspective of a seller, I can get all the assurances in the world from the owner that they have a great relationship with that customer and they've been doing business with them for 30 years, and that it's in no way tied to the fact that they are in the same bowling league and they're friends and so on and so forth. But when it really comes down to it, it doesn't really matter too much to a buyer like me, unless I have some guarantees that go with it. So typically what I would do in that situation is I would say to that seller, if you want to get what I would call the full market rate, so to speak, for your business, maximum value, with the notion that you have 1 or 2 extremely important and large customers that make up a majority of your revenue, I'm going to look for some type of either earnout or forgivable seller note situation. So something where if that customer were to walk within the first year or 2 or something like that, a portion of the seller price or the sale price would be forgiven in order to compensate and kind of adjust things accordingly. And I also understand that I wouldn't be looking at that business if I didn't think that there was a reasonable path moving forward to mitigate that risk and to expand the customer base and lower the customer concentration issues. But there's going to be a time window that needs to go along with it. And it's, again, just one of those key areas that high on the list of first due diligence request items, get a better understanding of the business, and will significantly alter my interest and valuation of the company if that customer list is incredibly concentrated.
Yeah, that is just so important. Is how tied into one industry or 1 or 2 customers is this business? Certainly when you get to one with 40, 50, 60, heck, even 30% on the revenue of the impact on the company, you can just have a huge negative impact if that customer decides to leave at any time when just shortly after the transaction. So you certainly want to be careful, about that. That probably goes right up there with how much time the owner spends inside of the business on a day-to-day basis. When you have high percentage in both of those particular categories, you're probably either going to want to walk away or offer a significantly less amount of money for that particular business. How much time do you spend, Peter, on the salary that the owner's taking and how they're taking their income out of the company?
As much as it takes. That's often a point of contention, right? It's one of those things,
Yeah.
especially in health businesses, where it depends, of course, on how they're paying themselves and how many personal expenses they're running through the business and what's discretionary and what isn't, and where they align up with what's a market rate and so on and so forth. All these valuations and assessments of the profitability of the business are going to involve what everyone calls add backs, right? Adjustments to the profitability, things that when you start to look at the historical financials are these things that the seller is choosing to do that, a new buyer or a new owner could come in and basically not have to pull out the same type of money. Obvious things that the seller might do or the current owner might do are things like running their own personal vehicle through there, or paying, having family members on the payroll that have little to no involvement with the business, things like that. But you'll also start to look more deeply in things that the seller might be running through that seem like discretionary, may not actually be discretionary, are important for the business to run. And whatever they say is a market rate for their salary and can be added back, it's typically lower than, or I shouldn't say typically, but maybe lower than what is truly a market rate. So a seller may say I can be replaced for $50,000 a year or something like that, but you might start looking and see the average general manager for a particular business in that industry is $90,000 or something, and there could be some back and forth there. But it's one of those things that I want to understand immediately, because it's usually a key source of understanding the nuance of that business and what is indeed what I would consider a valid add back for profitability versus something that the owner is getting a little bit generous with. So
yeah, those are some good points. I think I think all in all, in just a real straightforward way to look at it, it tells you if they're trying to run it like a business or it's more of a lifestyle business, and it's got to be kind of converted over, right? I mean, at least if they're taking a W-2 salary and then they're taking distributions, you know that hopefully some of the other discretionary expenses are just not overly excessive. But there's a way to just kind of work around what those numbers are. Did you ever get into a point or at a point when you're looking at a business, Peter, when you're talking to any of their competitors and or any of their customers even?
Yeah, and that's going to be at the tail end. Because I understand and acknowledge that going through this process, there's a risk associated with it. When you're a seller, certainly it can be very disruptive. You want to make sure that when you eventually start announcing this to employees and whatnot, that you're pretty close to certain that this is going to be happening, just for the obvious notion of how that might affect morale and people's views on the business and understanding who's going to be taking over. And that also applies to the customers as well, right? So I think especially if there are a few key customers that comprise a significant portion of the revenue, I'm certainly going to want to talk to them. I'm willing to put that off toward the tail end of it, because once again, I understand that day one, you're not expecting to go in and start talking to valuable clients if you're still 90 days out from a proposed close date. But towards the end, I want to talk to them, and it's not a deep conversation. I just want to get an assessment of how critical, what's their relationship like with the company, how long have they been doing business with them, what are some of the things they do like about doing business with that company and why they keep returning to them, and of course, what are some of the areas that they think can be improved, and are these minor, or these big ticket items, or are they things that you go, all right, yeah, that's a great idea, I think it's something that I can implement and add value with shortly after starting, but isn't going to be anything in the near future that would make this customer walk.
Yeah, right. I think those are some really good points. And do you talk about with the business about how much that business may rely on? Of course, we talked a little bit about this before, about them or just their overall personality, which will probably throw in a little bit of the goodwill when you get towards the kind of the back end. But just kind of another question off of that and comment is, how many times does the seller of the company ask you, Peter, why are you buying the company?
I would say that's a pretty big focus early on, and it's a two-way street for the same reason that I'm understanding why they're selling it. I think they want to know who's buying their business, why are they buying it, especially if it's more of a cold outreach situation where they didn't have it listed with a banker or a broker, and they don't have a third party that they've engaged at that's sort of advising them through the process. Somebody knocking on their door asking if they want to sell, I certainly want to dig in more and understand it. And that's why I want to be as open and transparent about my background, my profile, what my intentions are with the business moving forward, and profile, or excuse me, my type of investment criteria, things like that. But I think in all fairness, it's one of those areas that I would expect to answer questions on as early as the seller wants and as frequently as the seller wants, because it's for most folks, it's going to be the biggest professional decision of their life, or at least the last one of major consequence. And I think they have every right to know who they're selling to and what their plans are.
Yeah, I think that those conversations really early, I mean, there's several spinoff questions you can go from there. Is how did they start their business, or did they buy it from somebody else, and why did they buy it? I think these are good questions very early on in any of the processes, just because it allows you to have more information and you really kind of understand who is that person, really in front of you, right?
Yeah.
And I think it gives the two of you some kind of some common ground to really just start having some conversations, right?
Yeah, I agree. Because ideally you want this to be a comfortable relationship. You're going to be working hand in hand more and more closely every day up until the point of that close date. And depending on what the agreements are and how the transition is going to go, you may very well be working with that owner kind of on a day-to-day basis, looking over their shoulder and having their involvement for a span of anywhere from a few weeks to a couple of years or something like that. So I think you want to know who you're going to be getting into a relationship with and working closely with in the foreseeable future, and anything to help develop that rapport and comfort level with each other is always positive in my mind.
Yeah. So share with the people on the meeting today, Peter, what are some of the how do you want to say it? What are some of the things that have kind of gone south as you've gone through some deal purchases that maybe were just like heck, where did this thing really come from as you kind of work through the process? Have you had any of those experiences?
Yeah, I'm familiar with that. So I could spend the next 21 minutes talking about this. I'll try to just give a few examples, but certainly getting back to that customer concentration notion is always one, because again, it's folks that more often than not, they've been working their business for a very long time. Their customer relationships are very comfortable and established. And when you get into that concentration issue and importance, telling them that they've grown an account from 20% to 50% of their business seems almost counterintuitive to them. They're proud of the fact that they've grown business with a particular customer and they've established a relationship. It's great, but it also adds to that risk level due to a concentration issue. And that's often been a point of contention. I think another area that often comes up is the expectations for seller involvement post-sale. I tend to have some concerns if the seller says on the day of the transaction, on Friday, by Monday, I'm going to be in Arizona in my new condo and I'm out. It tells me that they don't have any real interest in what the business is doing upon their departure. There's ways to overcome that. If that's a deal breaker and they've done things like we've talked about before about setting up a really detailed succession plan and have processes and documentation and stuff in place, I think they've earned a little bit faster exit. So I can understand that, but that's been a point of contention as well. Certainly how the structure of the transaction is going to look is often a big point as well, because some owners have an expectation that it should be 100% cash at close. Some are okay with the notion of a seller note, but the terms of that seller note can end up being contentious as well. And what are the rates going to be and how fast they're going to be paid back? And, is it subordinate to this, assuming it's subordinate to the senior debt, and what covenants are in place there. So that's another big point of concern as well, and something that I think it's really important to be on the same page with everyone. And more often than not, I think one of the, at least in my experience, I'm always surprised by this. One of the areas that things fall apart is just in the initial offer. I'm always fascinated by my experience, the very high proportion of sellers that will get an initial offer, and if it's not their dream offer, everything isn't lined up perfectly how they want it, they just walk away or have no further interest in having discussions. And this is just my little PSA of saying negotiation is a very important art and is should be embraced. I'm once again, it's baffling how many offers or sellers I'll talk to. You put an offer out and then you find out they don't want to sell and they're no longer going to pursue it. And the reason is because it was 10% below what they wanted. And you go, well, there's a way to overcome that. And I'm happy to be flexible on it. I think there should be an expectation that an offer price is a starting point. It's just that, and that there should be some back and forth. But I've seen a lot of what I thought were potentially good deals and promising opportunities fall apart because an offer came through and it wasn't absolutely perfect on all points. So I just stress for business owners and whoever's advising them that, look at that as an opportunity to start having a back and forth. It doesn't have to be all or nothing on that first pass.
Yeah, I would suspect that probably starts throwing up a few flags for you when they, when they're walking away, and might be a blessing in disguise because there was probably some underlying issues going on with that company that maybe they didn't really want to, bring to light. There's a reason why only 20% of the companies that go on the market actually sell. And a lot of it is just because the selling owner is not giving the buyer, like Peter, accurate and timely information when it's asked for. It just might drag on for too long, and that can leave a bad taste in your mouth. I'm sure you probably had that happen a number of times, right, Peter? Where maybe they just don't even get you any data for no reason for a long time.
Yeah, everyone says that time kills all momentum and whatnot, and momentum is important to getting these transactions done. I think you're 100% right there. And yeah, it's happened to me a bunch of times. And actually, the business have under a letter of intent right now, I had actually submitted an offer to a different business prior to that. And what happened was I just didn't receive a response back in a timely manner. And by the time several weeks later that they had gotten back to me, another thing had presented itself and was slightly more attractive, and I was able to move forward there. But for that owner, I'm not saying that I'm the last buyer on earth. I'm sure they'll be able to find other folks, but if it was someone that they're comfortable with and whatnot, speed is paramount for both sides. So I think you're right. Getting back in a timely manner and trying to keep things moving as much as possible is really important.
Yeah, and I think it's also the expectations, right? Is like, what kind of advice or what kind of education is the owner doing on the other side to make sure that they understand what the expectations are, whether it's the offer isn't quite where it was supposed to be when we started, or it's, there's a long list of things that it could be, but it's how to understand that you're correct, that this will be probably the largest transaction that they ever do. And it can be somewhat of an arduous process, for both parties to kind of go through it, because it does take some time to get this to the finish line, right?
Yeah, you're going to get a lot of third parties involved. It's going to take some time. The bank loans have to be processed, and lawyers are going to go back and forth with purchase agreements and non-compete agreements and anything else that goes along with it. Third parties might get involved, like accountants who are going to ask for questions around doing a quality of earnings due diligence, or insurance companies who are going to come in and ask for run loss reports and various data that's going to allow them to do an insurance assessment. And depending on your industry, other third parties might get involved to do due diligence on equipment, or if you're selling real estate, environmental concerns around the land, all these different things, right? So there's a lot of moving pieces, a nonstop probably flow of questions and data requests to the owner that I'm sure can be frustrating or cumbersome at times. I just think it's important, like you said, Vincent, to understand that this is an expectation of it. If you want to sell your business and you want to maximize the value for it, and you want to work with a potential buyer that's thorough and is going to be a good steward of it moving forward, they're going to want to know as much as possible about it. And that's certainly going to take time and investment from the seller's side in terms of putting all that data together and providing all that information.
Absolutely. Let's talk a little bit about debt and litigation. So share with the listeners we have today, Peter, how do you perceive and how do you approach debt with the company and taking that over? Like, whether you do it, it's off the table, or it depends on the type of debt that it is. Tell us how you handle that if the company has debt and you're coming in, because most of the time I assume you're looking at an asset sale, correct?
Yeah, exactly. So I probably have a much more limited view of this compared to some other buyers, but typically the approach that I look to do, and many people in my shoes look for transactions of this nature, and that's the cash-free, debt-free asset purchase. So what that entails is buying all the assets of the business of consequence, effectively buying the business without actually buying the business, if that makes sense. So buying all the assets and everything that the business needs to run, but not actually buying the existing corporation or shares of the corporation. And with that, typically what people do is they do it on this debt-free, cash-free basis. So the expectation is that the owner, any cash that's in the bank that the business has generated, the owner takes all that with, and they also assume all the outstanding liabilities that the business has. So I typically avoid debt getting into deals. Now, that's for all the long-term debt. On the short-term kind of current liabilities, I typically expect to take over all accounts receivable and accounts payable. So, if you're viewing accounts payable as a form of sort of immediate debt, I would expect to take that on. But anything long-term outstanding loans or anything like that is usually the expectation is, along with the cash, the owner is going to assume those liabilities as well. So I tend to stay away from them. If that's one of those areas that's non-negotiable and has to happen, and if for whatever reason it's still an opportunity that I want to pursue, then I just add it to that list of questions we want to start to understand really early, and get an understanding of what the expectation is for both sides as soon as possible.
Yeah, and certainly the asset purchase is also helpful for any litigation. So if you're buying the stock, you obviously could inherit even some future litigation down the road that may not have happened yet, or maybe in the beginning stages. So I think that's why there's a good way just to kind of, when you're purchasing it, really, it really does help to alleviate any of those issues that might pop up from a debt standpoint and or from a litigation standpoint, right?
Absolutely. It just, simplicity is always a good thing, and it simplifies the transaction for a buyer. It eliminates a lot of those areas that you're talking about from a pure legal and tactical standpoint. So it's helpful there. That said, if there's, I'm flexible. If the owner absolutely, for various reasons, wants to do a stock purchase of the deal of the company or something like that, it can be done. I'm not saying that I won't look at opportunities like that, but it just, again, adds some additional complexities and probably will involve a little bit more involvement from the owner in terms of providing all that information that goes along with those risks and liabilities that you were talking about, Vincent.
Yeah, because that can help really finance a deal when you do an asset sale and kind of take some things off that you're getting some deductions on your end. But when you're picking up the stock, then you don't really get some of those, some of those benefits. So certainly we know what the benefit is to the seller on a stock sale, because you're getting it at capital gain. But on an asset sale, and some of that really can also be done under a goodwill. So you're still doing an asset sale with a percentage of it being under a goodwill, so they can be, leverage out some of the more favorable, tax rates that are out there. I want to kind of go back to when we were talking a little bit about, the owner who, signs one day, the money's wired the same day, and they're off to Arizona to the new condo. Those are, in some cases, certainly understanding some of the expectations and maybe even taking a look at, should there be some kind of a standby clause in the purchase, just to kind of make sure if things play out the way that they're supposed to play, then the person will get the money at the back end. But until that comes out, then, they're not really going to get any money. Have you used any of those clauses in any of the purchases that you have, or not familiar with them?
No, I'm familiar with them. I haven't had to use anything too stringent like that just yet. I if the opportunity were to arise, or the need were to arise, I should say, I'm familiar with it, and it's a good way to protect against what you're talking about. That's why I typically like to have a portion of the sale price be a seller note, so that they have some skin in the game and some interest in seeing that business succeed afterward. I also understand that I'm not expecting them to play the bank, so to speak, and finance 75% of the deal on their own, but as long as I can make it a portion that is significant enough in value where they would have a very strong interest in making sure the company doesn't go bankrupt in the next few years, then I feel adequately enough protected, that the seller will be around at least for a transition period to help things move smoothly, and will probably be willing to take my phone calls here and there for the next couple of years as needed. And that's about all I can fully expect from someone, because I get it, more often than not, they're retiring, they want to move on to their next stage of life. That's fine, and congratulations to them. But I just want some assurance that, with that 10, 20, 30% seller note, that they say, all right, if 25% of my value is tied to them basically running the business and being able to be profitable and pay it back over the next 5 years, I'm going to make sure that I do my best to help them in the immediate with answering any questions, providing any information they need from a transition. And like I said, if something comes up 3 years from now and they just have a reason to pick my brain for something, I'm not going to worry about giving up 20 minutes of my time in between tea times in order to answer a question or something like that.
Right. Yeah. Let's talk a little bit as we kind of get towards the closing part of our conversation today. Tell me, once you get down to the you're at the end, everything's been signed, money's been paid, wired, however the money's being transferred over. Tell me some of the feelings, or, you know, how do you feel as an investor once that happens? Are you like, oh, glad that this is over? Hey, let's get to work. You know, let's get underneath the hood and really kind of get this thing moving. What are some of the, we know what some of the things are from some of the sellers that kind of go through, but what is it from a buyer's perspective?
Well, I think it's all the above, right? There's a relief that you've hit the close date, that ink is finally drying on the paper and everyone's actually signed, and that you know you're able to move on to the next stage. And yeah, there's the excitement that's going to go along with it about stepping into this new business, or at the very least having this new business that's now a part of an investment portfolio that you get to monitor and provide value to in some form of capacity, or counsel, however it would work. And then there's naturally probably the the other thing that starts to set in is the stress, fear, whatever, that all right, now it's everything up to this point has been on paper, right? It's been modeling and projections and thinking about why this is a good acquisition, why you've been selling this pitch to investors and are willing to and have been selling this to lenders and perhaps sign personal guarantees on debt and whatnot and move forward. And then, yeah, there's the reality that you have to step in. So, you know, for someone in my shoes, with more of an owner operator viewpoint, the first thing I'm thinking about is, all right, now this is going to be officially announced to all the employees and to our customers and to our suppliers and whatnot. What is my game plan and my speech and my address for touching all those parties next? Because that's really going to be the first order of business, is having this conversation with everyone, announcing that this is official, ownership has changed hands, and what's the future going to look like? Because it's easy to be selfish and focused in my own world and say, all right, what do I feel as a buyer and investor as we've gotten into this? But you know, really, truthfully, it's a lot more people that are affected by it, and in that broader ecosystem of that business, it's much more important to address the feelings, concerns, the next steps with all the people, the vast majority of which that are making the business run, versus a new owner like myself, who, yeah, I have work to do and I'm going to be involved with it, but you know, my stress is limited to one person. I really want to look out and see, you know, are our customers satisfied, or our suppliers satisfied, and are the people that are working at the company, are they, am I able to address any of their questions right away?
Yeah, yeah, certainly you want to get in there and start moving things forward, and now really get a good chance to see, you know, who are the players that you have that are going on the field, right?
Right.
And you know, what's the quality of those players, and being able to take this company where you want to take it, right? Lisa, do we have, I'm going to take a minute. Lisa, we've got another slide here that we want to share with the group. We can go ahead and go to the next slide, and just kind of want to talk a little bit about and pull up that information there. Let's talk a little bit about some of the things that investment buyer might look at. You know, certainly any executive summaries, we can pull them all up there, Lisa. Company management, certainly. If you're going to do any financial analysis, what have they done and what can you do? You know, what competitive advantages might they have? What is their business model? You know, certainly market size. How much can they really scale this business? So I'm guessing, Peter, if you buy a company that's doing, you know, 2 or 3 million or 20 million right now, and you want to scale it up at a much higher rate, you got to figure out, is this business even scalable, right?
Yeah, absolutely. Is it scalable? What is the path to that? How achievable is it? What is the timing of that? You know, I've yet to meet an owner or a banker or broker that doesn't think that there's all kinds of untapped potential in a business. But I think it's a matter of understanding how much of that a reality, and how achievable is it? Because I'm sure there's a lot of businesses that could grow by 50% over the next 10 years. But the effort and capital needed to do that is the bigger story there.
Yeah, that is a lot. Certainly any research that you can do on them, and then certainly what are the products and or services that are offered, right? Is there an expansion on that? Where can they go? And how does that play in? So having a good understanding of all of these and many other facets when you're looking at, you know, purchasing a business is going to be really important for you to have a good understanding of that. Lisa, what do we have on the next slide? So we pulled up some information of small businesses funding barriers, survey of over 86,000 small businesses. Certainly 48% afraid to borrow money because not sure they can pay it back. 25 don't know where to get the money and need help to get the business and open it up. Certainly on taking on debt, don't know how to apply for a loan or other reasons, right? So you want to make sure that if you're looking at purchasing a business, that you're taking a look at what are all the things that you really need to do to be able to prepare for that purchase. How are you going to fund it, whether it's going to be cash or whether it's going to be financing, whether it's going to be a combination. Do you have some investors that are going to go in with you and it's going to be kind of like a partnership, so to speak? How is all that going to work? So you really, really want to take a good solid look at where's the money going to be coming in from a funding perspective, get that out on the table from the very beginning. And it just makes it a lot easier as you kind of go through the conversation. Peter, I want to thank you for being here today. The information that you've shared with us and the folks that are on here today, and people who listen to this cast afterwards, I think it's very important for them to have a good understanding of what people like you really look at when you're going to buy a business. And it doesn't have to necessarily be, this painful, root canal as you go through it. Certainly there's going to be some uncomfortableness as you go through the process. But I think it's also important that if you are upfront and just talking through some things, good, bad, or indifferent, two intelligent people are probably going to get to a point where they can work out a deal and move on down the road, right?
Yeah, fully agree. Happy to have the conversation. And I would just say, if anyone ever has questions in the future or just wants some insider input, I'm always happy to give my perspective. And yeah, Vince, I agree. I'm probably more of an optimist than most on that front, but I also think that it does not have to be a painful process. I think a couple of parties can get together, and if they have similar goals in mind and oftentimes can start to come together around visions and for the business in the future, I think it can be a very amicable process. So, I like you said, I think just expectations and communication as much as possible really goes a long way.
Yeah. Thank you. Appreciate it. And thank you for being here today. Just in closing, before we go, our next owner fireside chat will be in February, and we're going to have Terry Dwyer, from the Breakwater Partners. And he also deals with sales accelerators. So he's going to be talking about sales strategy and sales projections. The top 5 key performance indicators is what we're going to be talking about next month in February. So hopefully you'll have time to join us for that one, because that will be very, very good. Remember, sales generates revenue for businesses no matter which one you're in, right? So again, Peter, thank you for being here today. Thanks everybody for listening in. Hopefully you've got some great information today. Again, this will be up on a YouTube channel here in the next 24 to 48 hours. So if you want to look at it again, certainly there, share it with some people. You certainly can do it through there, and appreciate any feedback that anybody has on our meetings here today. So we look forward to seeing you in February, and have a great day. Thanks, everybody. Take care.
Thank you. Very nice.
Thank you all.
Appreciate it.
Take care.